Our next guest says right now it's all about the normalization of rates, the end of free money, the return to fundamentals. And in this environment, he's finding plenty of opportunities in both growth and value. Joining us now is veteran value investor Chris Davis, chairman and portfolio manager of Davis Advisors, a longtime Berkshire shareholder and board member. Chris, it's great to have you back. Thanks for your time. Welcome.
Kelly, I'm always glad to be here.
Can I just start with your reaction, kind of top level to what's going on with bond yields? And there's so much more to dive into, but how would you describe kind of financial markets at the moment?
The system is very fragile. It's been grossly distorted and overextended over more than a decade, almost a decade and a half, in which basically money, the price of money was distorted and manipulated and held artificially down in the face of an enormous amount of money being printed. And I think we're just, in the early innings of this unwinding. And it means that everything is very taut. And I think it is a time when the people that imagine somehow that we're going back to what we've lived through in the last decade are absolutely out of touch with reality. The system is pulled taut. There's very little leeway in it, and you better be focused as an investor on characteristics like durability, resiliency. Be prepared, because strange things are going to have happened, started happening, and are going to continue to happen.
Ooh, I like that. I was going to actually segue into some of your stock picks, which are not what, people might have heard this morning before, but be surprised at your holdings if they're not already familiar. You have big cap tech in here. You've got big financials. But before I dig into that, Chris, what do you mean by more problems could be happening? Like, what do you sense as a veteran market watcher is kind of lurking out there?
Well, you think about what happens when money is free, right? No basic models of financial analysis work. All of value investing is based on a discounted present value. If there's no discount rate, it doesn't work. Yeah, CAP-M, the price of capital, all of these distortions that were created in this idea where for the first time in 3,000 years, money was free for a period of time. So what happened when money began to be repriced? This is a return to normalcy. There's going to be a hangover from popping the biggest bubble that I think any of us will ever live through, was the bubble of the fixed income markets. But it wasn't just in bonds. It wasn't just that, my God, you could lose 50% owning a 30-year government bond. That was just, it's still not in people's consciousness. I don't think people realize it. So then you saw the problems in the regional banks that had grossly mismanaged their balance sheets, taking enormous interest rate risk. Well, now I think you saw it in some hedge pension funds in the UK. But when I look at things like private equity, I look at venture capital, I look at certain parts of commercial real estate, I look at private capital markets, there is an enormous amount of risk that still needs to be repriced in light of the fact that capital, once again, the cost of capital needs to be factored in.
It's fascinating and a good setup. We'll be speaking with a private credit guest a little bit later this hour. So let's talk about what a company like Berkshire does in the middle of all this. They have $157 billion of cash. Where do they put it to work?
Well, first, I'm a director of Berkshire, so I can't make any comments about Berkshire's positioning. I think one of the things that every Berkshire shareholder and every other company should study is the quality of Berkshire's 10K. All of the information is in there that investors would want and that we would want if our seats were reversed. And so I really would recommend that. But I will say I've been a Berkshire shareholder for 30 or 40 years. And what is the most powerful aspect of Berkshire that I think doesn't get appreciated when everything is sailing smooth, but what comes to get appreciated in times of dislocation and transition is that place is built to last. Durability, that notion that you are a fiduciary of your shareholders' equity, that is so deep in that place. And certainly the recent results just indicate that culture in spades.